welcome to Trading with Technical Indicators. My name is James Boyd. We welcome all of you here today. Hopefully you had a great weekend. I did see a comment on Friday about happy Passover. I want to respond to that. Yes, I did see that comment. I hope you had a great weekend with you and your family. And this week, another great week. And I just want to let you know I did see that comment, and I felt bad that I didn't respond to it. So I want to get to it right off the bat. Hello, Bill, Will, Kurt, Tatiana, Fayez, Dave, Robin, and many others. Welcome to all. We also, for example, as we get started, the question was asked, where is Jax? Jax is on the stairs, and he will not be joining us unless he busts through the door. So a little fun with that, but he is a team player, so I want to make sure that I answer that question. Now, remember, I normally teach this session at this time. This class is being recorded. And a quick heads up, if you said, well, where could I see that recording? Playlist. And so, hello, Kenneth, you're the man as well. If you go to the link I just sent to you, okay, this will give us the playlist for this class. So save the playlist and you can go back and see any topics that we discussed before, okay? Now, also, just real quick as we get started, remember the information we talk about here today is for general informational purposes only. Should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. I'm going to think of it like a buffet, okay? Some of the things we talk about you might really like, and other things you might say, that doesn't really interest me as much. That's okay. We're all like that. Also remember that options carry a high level of risk, not suitable for all investors. When we talk about examples, those will be done in the Paper Money software application, okay? And also remember that investing involves risk, including loss of principal, okay? And also want to give us a quick reminder that we were in Detroit over the weekend. Kevin, Barb, and Ben were at the workshop in Detroit. If you go to schwab.com/events, we will be coming to Denver, the Rocky City, May 2nd and 3rd. That's a technical analysis as the first day. Second day is option strategies. If you and so they break it up on and that will be for May 2nd would be the technical analysis, and the May 3rd the option strategies. So they don't overlap them. They break it down by day like that. Now they are free to attend if you are a Schwab client. You can go to schwab.com/events to see other areas in which we're coming to. We'll be also going to Anaheim to do the advanced option seminar. And also we have what's also called a market drive. Market drive is where they kind of talk about a confluence of subjects. That will be done on a one-day format, June 13th, JW Marriott Turnberry Resort. So different types of events all throughout the country. Feel free to join us, meet other like investors in your area. Now, some of you might travel to those areas. Wonderful. Love to see you there. Just go to schwab.com/events and you could join. Now, quick discussion of what we're going to discuss here today. Last Monday, I came back from vacation. The market said, hey, James is gone. I'm joking. And the market fell. I'm joking, okay? I'm joking. So last week, we kind of talked about maybe being prepared for sell-offs, right? Well, we did kind of 2 or 3 bullish examples from the steep sell-off. Last Monday, the VIX was what, at 60? Let's go back and double check that. And I want to kind of talk about where the market is now, and is it continuing to heal? Okay. Now I can tell you what I think, and it's just an opinion. And I know that, okay? We all have opinions, okay? But usually when you invest or trade, you usually have to have an opinion or an idea of what it might do. You don't know what it's going to do for sure, but there's a premise or an idea. Now, also, we're going to talk about some of the indicators that we're seeing that might be leading to potentially the market healing a little bit. And we're going to look at some examples on the chart. Now, as we do examples, we'll talk also about picking strategies. And that's kind of important to pick some strategies that might kind of, where you're kind of having an idea of what that trade might do. Picking a strategy that might kind of run parallel to that idea. And also maybe some risk you might see on the chart. Maybe there's upcoming earnings and so on. So we'll be mindful of strategy selection in our examples. So first off, let's go just take a look at the SPX for just a moment. Now, we have the Fibonacci on the chart, and this has been very kind of important for us to watch Okay, let me just kind of set our eyes here. This is where the market topped out at 100%. This is where we fell down to. And I did the wick. Some of you like to look at wicks, so I'm going to meet you at the wicks right now, okay? Now, if we take a look at this, one thing that's been pretty amazing is if you look at just the move since last week. So this is what, Friday, Thursday, Wednesday, Tuesday, Monday. So this green candle right there was last Monday, okay? That's where we were last Monday. The market last week was at 48.32, and if we had said, that's it, sell everything and go short, okay, well, it didn't turn out too well so far. And so the market moved about 10% from last Monday to today. The market did, the SPX. Now, what we talked about is if we're thinking it's going to be a bear flag, you tend to like to see the market stay below the 23.6. You like to see the market stay below 38.2. Then all of a sudden, if you start getting below the 50%, you're now starting to wonder, wait, where's all the sellers? And if you start going even higher than, let's say, 68, 61.8, you're like saying, wait, I thought it was bearish, okay? So this is why we kind of did the examples that we did from last week is sometimes when the VIX is that high, 60, which is probably the second highest I've ever seen it. The highest I've ever seen it is 89. You don't get that very often. And if you do, some investors might want to kind of say, look, I'm going to take the opposite of fear and go long, where the other investor goes short or bearish or they exit. If you take a look at this, if we can again start to close above 61.8, that 78.6 level is kind of where we broke down from, okay? So now we can look at this and say, well, the market isn't doing squat. Well, that's okay sometimes because you want the range in the market to contract. Why? Well, the range of the market from high to low, if the market contracts, the volatility goes down. If there's less volatility in the market, some investors might be more apt to be willing to buy something and push some of the prices higher. Friday, we did an example of going short volatility. It's up about $650 so far. I can't bring it up, but that's where it stands since Friday. That's in the margin account. We'll look at that in just a moment, margin account in whole. But if we kind of talk about, is it healing? This was one of the gap downs we actually had. There's a hole there. We're trying to complete that by getting above that. There's another gap down level right there. So right now we're trying to just fill those holes on the chart. And so far it's holding. Okay. Now, if we went to just real quick, the VIX, what you're going to notice with the VIX is this is where she is. Now, again, as a bullish investor, you love to see the shorter term moving average go red. Go red. Some of you say go red, baby. Okay. Now, you also like the fact that it did a crossover. I know what you want next. You want that 20 period moving average to go red too. Yeah, look, we know where you're going with that, okay? But at least that's a start. That was a fresh new low, okay, today. And again, the VIX still at really 33.93. The VIX is at 16. The forecast is the SPX moves about 1%. Do the basic math again. VIX is at 32. S&P forecasted to move approximately about 2%. Now, last week when we were hitting 60, do the math on that. It's about 3.5 to 4% movement on the S&P. So as we're bullish investors, or if you would consider that, in our examples I'm talking about in the paid money account, the biggest thing is you want volatility to contract, especially if you're a bull, okay? Now, I want to now just real quick to kind of talk about some of the numbers we're seeing just real quick. So on Friday, we had a great discussion on currency and commodities, okay? Now, just a quick heads up. The yen, it's still up. The British pound, it's up. The euro is still up. The Swiss franc is up. And the dollar must be getting pushed down. You could type in $DXY. That's a basket of currencies relative to the US dollar. US dollar down again, okay? Great discussion on Friday. Heads up, on Friday, we will not meet because the market is closed. It's Good Friday, okay? So sad that it's not ETF day, but if we were going to be kind of not be having webcasts. Well, it's Good Friday, okay? So we'll take a break. But next week we'll be back and we'll talk further about that. Great discussions there. Now, the one thing I want to kind of bring up is if we pulled up, let's say, let's go to just real quick, the sectors real quick, okay? And then we're going to look at some examples. So if I looked at, let's say, sectors, what you're now going to notice is the things that we talked about is looking at this trend column first, right? That's the number one column to look at to kind of see are things starting to heal. If things are starting to heal, okay, we should be seeing a lot of twos, and we are, okay? Now, we know that if we're getting a whole bunch of ones, that's not typically what the investor wants to see. So twos, that's a start. The only area that has really a three, we're including gold in the sector list because I've been saying that really the precious metals have been acting like a sector, okay? So that's number one. Can anyone else see something that we said, watch this column in number two? What do we say as far as watching as well? Well, we said, hey, you might want to keep an eye on this 10HC column. The 10HC column is the the 10-day whole moving average. The HC stands for just the whole counter. What does that even mean? So why is there a green background? Well, the moving average color could or should be green. The number in the box represents the number of days where the moving average has been green. What do you notice? Well, first off, all the sectors, including gold, they're green. And the last 2 to 3 days, they've gone up. Now, remember when we talk about scripts, they're not guaranteed for accuracy or timing. You want to have an understanding of what that script is trying to do and verify that it's really showing what it states. Okay, so you verify. Now, the one thing is, so that's number two, and that's a better sign. Some investors might say, James, I want to see further confirmation, the 20-day whole moving average. Are there some actually getting a little bit more of a turn there? Yes, in the last day, or today, I should say, and 2 days also on gold. So we see technology getting a little bounce back, staples getting a little bounce back, basic material, industrials getting a little bounce back there. Meaning that both of the moving averages are green. Fourth column that we're going to pay attention to is yours truly, the MAX, the moving average crossover. Now, the green background with the X in it just means that, for example, there's a cross today. It's not guaranteed for accuracy. Verify that it is. This is not guaranteeing that it's going to go up. It's just showing the condition right now, intraday. Verify. And the X plus one just means that cross happened on Friday, okay? So there's starting to be some signs that some areas are starting to heal. And that kind of makes sense because a lot of investors tend to be bullish. Things drop, they have funds to invest, they might try to, for example, try to get in, okay? Now, let me go back to a quick comment. This 20 right there is the 20-day whole moving average. The reason why we call it HC is there's the whole counter. It's counting the number of days that the moving average has turned up. Now, let's shift to just kind of, let me give you a quick example. So if I said, and I want to show you visually what this looks like. So if the whole moving average turned green right there, that'd be day one. This would be day two. This would be day three for the sector of utilities. So on the market watch list, it might say something like, hey, it would have a green background with at least 2 days, maybe 3 days. Now today, we would also see on an MAX, there could be a crossover happening as well. We do not see the 20-period moving average going green. The key word is yet. Now, Gazelle actually says the question is, are your RS columns versus SPX or what? You really want to know? All right. They're tracked to a product. Let me just double check. But I can't show that. But the answer is it's tracked to the products that we talked about on Friday. Okay. And so it's a product that's like the SPX, but it's a basket of stocks. Geez, that was like leading the witness, but that's what it is. That's how I'm getting a read there on the SPX, okay? Because I believe if you actually gauge it to the SPX itself, that would blank out and not give you anything. But if you use the products like we talked about on Friday, you know, you're going to get a read on the SPX. That's how I'm getting a reading on that SPX column. Not anything major, okay? All right, now, I want to kind of show something because really the whole point is kind of take some of these ideas that we're talking about and maybe practice trade. What about the cash? We got 24,000 in cash here, okay? So this IRA account example given is we're trying to use, well, this account has more capital to buy shares of stock, okay? Now, and you will see that there's more stock positions and that stock eats capital. If we go to the margin account and said how many stock positions we have, answer, not very many. We have AU, which is a $34 stock, and you have MO, which is a $56 stock. Not much, okay? Now, what I want to do just real quick is I want to go back to, just real quick, let's look at some examples, okay? And let's kind of try to see if we can't use some of that capital in the margin and the IRA, okay? So here we go. Now, one thing I want to kind of just show just real quick is, and I'm going to go back to the example that we did from last week for just a moment on Palantir. Now, when we look at Palantir, that was the one that was last week down here, and then now it's there. Now, I just want to see if we need to do any maybe management on that trade, if at all. And let's just kind of verify that it's still there. And so if we look at that trade, let's just verify that was not the one. It was probably done in the IRA. There it is. So on Palantir, the trade that was done really last week that got filled, that's the trade from last week. So this, if we take a look at this trade only has 3 days remaining. Some investors might actually kind of look at the totals of that and say, James, I'm going to take that trade down. I'm going to go to Palantir for just a sec. Let's go to setup. Let's go to application settings. And let's just go to positions and then day percent open, okay? So what I'm trying to do is kind of see, so first off, this position. If this was your position in paper money, what would you probably do with that position? That's correct, Bob. Okay? That position for many investors, they might say, James, that I'm going to take that down. That's over 90%. We're going to right click on that, create closing order. We're going to buy that back, okay? We're going to buy that back. That's at 90+%. We're going to buy it back. Notice it's leaving some of the debit remaining because when you got in, it was a credit. When you get out, debit, okay? Confirm send. Note the commission on the way out, okay? That adds to the debit plus commission, send the order. Now, what I'm going to do on this is so that's first thing is I saw that. I want to kind of come back to that. Now, I'm also going to go back to a couple stocks here that kind of look a little maybe, well, for some technicians, they might say, James, these seem to be bullish, okay? Let's take a look at some stocks that where a technician might think that they're bullish. I'm going to go back to Philip Morris, okay? Now, as a technician, you're trying to really gauge the trend, okay? What we talk about from day one is, what is the trend? And we talk about different types of trend lengths. Short-term trend lengths would be days to weeks, weeks being 2 to 3 weeks, okay? Intermediate would be 2 to 3 weeks to 2 to 3 months typically, or months. And then like longer term would be months to years, okay? If we look at this chart, what type of trend are we seeing on Philip Morris? What do we see? Now, if I kind of zoomed in and said, okay, in the last couple of days to weeks, given that duration of time frame that I talked about, the criteria to what is short term, days to weeks, I think we would, if we were all on the same page, we'd probably say, James, it's been more neutral. If we said intermediate, 2 to 3 weeks to 2 to 3 weeks to 2 to 3 months or months, if we use that criteria description, you'd maybe have to say, James, it's up, okay? Longer term, back this chart off, it's gone from the lower left to the upper right, okay? Someone might say it's an uptrend, okay? Now, if we take a look at this, I'm going to zoom in on this. I want to kind of go back to something we talked about, which is not always normal. We had a support level at 150. Why do some investors buy below support? Why do they do that? Why did someone buy here? Why did someone buy here? Why did someone buy here? Why did they push it up here? Didn't they know that actually the support level is 150? Why would they do that? Well, sometimes people have large amounts of portfolios where they actually say, look, we're going to try to take advantage of that sell-off, and we're going to try to buy, and we think we have enough capital to push it back up. We think when people come to their senses, they're going to want to buy Philip Morris. Maybe that's what the investor is thinking, okay? Now, we got earnings coming up. Now, earnings for one company is not the same for everything. When we go to, for example, to analyze, and we go to, let's say, fundamentals, some companies, they tend to be more consistent in terms of their revenue. They're selling products or services that tend to have more resiliency or consistency of revenue and earnings per share. Now, if we look at this sales per share, revenue per share, you're going to see that it's been pretty consistent, okay? Pretty consistent. And if we look at the earnings per share, okay, net income divided by the number of shares outstanding, 516, 583, 581, 502, 452. Maybe this is why some investors kind of maybe like some stocks that tend to be more persistent in terms of their fundamentals. Now, you go back to the trade tab just real quick, and we're going to look at different stocks here. Does it have a dividend yield? Yeah, the dividend is $1.35 a quarter. The yield, expressed on a percent terms, is the annual dividend divided by the current stock price, 3.43. Okay, so it's not massive. It's less than T-bills. Go to the trade tab, and what I'm going to do on this is what type of strategy. Now, this is very important here because you could see the trend. You could see the support and resistance. That's a starting point, but what type of strategy? What type of strategy? Now, when we say what type of strategy, we also kind of have to say what type of account do you have? How much money do you have? The investor might be thinking. Okay, so if we went back to, let's say, the margin account and said, well, the margin account, could we buy some shares? I mean, we could, just don't have a ton of capital to buy the shares, okay? Could we maybe do like a directional trade? Well, what's a directional trade? Well, we would say a directional trade is probably anything that has a delta greater than 50. What has a delta greater than 50? Long call, perhaps? You could say a long synthetic, okay? Long stock position. That's if you want to be directional. But wonder if you said, James, I want to kind of do something that has some direction, but also some time as well. You could say a cash secured put. If you said, James, I want to kind of play more like a vertical spread, where it's somewhat based on probability, but has some directional upside potential as well, higher than a short put vertical. Well, what we're going to do in this case is we're going to go to the trade tab, and what I'm going to do is I'm going to go look and see the volatility. The PM volatility, it's still in the mid-30s, pretty high. Some investors might say, James, I'd like to sell something in that case. And what I'm going to do in this is if the investor said, James, I want to trade probability, okay? I want to define risk, and I want to trade more about probability. Well, if the investor said, I'm going to go the maze, 20, 50 days to expiration, sell the 150s, okay? And what you're now going to notice is the bid-ask spread is pretty far. Now, what does that tell us? What does that tell us? So first off, notice I led you down the path of just thinking we're going to do an option trade on this. You have to verify. If you come to, let's say, these and say, are these tighter? The open interest, for some reason, the maze, this is why you cannot just say, do the options that have 30 days to expiration. Because some of these expirations might not have liquidity. You go look at the June expirations, there's a little bit more liquidity. And this is why we talk about a starting point or a range, but each stock, we need to verify how liquid is it. Where's that open interest and a tighter bid-ask spread? So in this example, if someone said, James, I want to trade probability, well, they might be choosing maybe selling the 150 and maybe buying the 145 or 140. We're going to close the maze. Now, if someone said, James, I was kind of thinking, now, I want to ask you a question. Michelle, Dragon Rider, Julia, Ray, Villager, how many of you are thinking you might want to do a trade that's more directionally based? And what I mean by that is has a higher potential upside compared to a short put vertical. Any takers on that? Speak now or forever hold your peace. Well, if we went to that call side and said, okay, we talked about the short put vertical, more probability based, but what if we came over here to the call side and we said, look, we're going to buy a long call, okay? We're going to buy a long call. And what I'm going to do on this is I'm going to look at the 150, 150, 160, okay? If I look to the 150, and I'll start here. If I look at the 150, 155, the debit is $3.30. That represents the most that we could lose given the vertical. Now, we're going to do this in the margin account. We're probably going to pick a $5 wide spread there because we're trying to keep all the losses about 1% of the account value. Okay, so you need to think about that. If you said, James, I got a bigger dollar account, I could take a bigger loss and still stay below the percentage threshold, the IRA. We're going to do the 150, 160 in the IRA, one contract, not two. And we're going to do the 150, 155 in the margin account. Why did you do that? Because I can't take a $600 loss in the margin account. It's too big. So that's how you're kind of saying, here's what I'm willing to lose. And you might change the strikes with based upon what account you're trading out of. Now, speaking of that, let's go practice that. Now, we're going to go to just real quick, PM. Let's look at we're in the margin account. We're going to take the 150, close that May, go to the Junes, 150, 155, okay? And if I did that right there, 150, 155, $3.30 debit. Now, the biggest thing is we want to make sure that this is the mid price. It is, and what we're going to do in this case is go confirm and send. Note the max profit is 170, max loss 330. Now, James, wonder if you went the 155 and you went the 160, okay? Well, if you did that, that is your more classic where you're risking up one to try to make one. And what I mean by that is, well, you're trying to make 220 and you have a risk potential of 280. Now, if the investor was more optimistic on what they thought the stock could do, and nobody knows what's going to happen, they might choose that one. And that's what we're going to do. Now, we're going to go ahead and send an order. Notice the commission as well. Send. Now, the comment came from me, to me, about what about the caller position? That's on MO, not Philip Morris, from what I can remember. However, now I don't see that in this account we have a stock position. What about the IRA? We do. And so this is even more interesting. So notice right there, we have a caller position on Philip Morris. So we have a Philip Morris caller and a Mo caller. Who said that? Let's try. Skylo could never get it over you. You know what's going on here. Now, this is kind of interesting because what you're going to notice is that trade was put on all at the same time, okay? And you're going to see that the overall gain from last week to this week is really sitting at $180. Now, remember, a caller, when you put it on, you put it on all at the same time, buy the stock, sell the call, buy the put, it's like a vertical position. But the strategy really has a little bit higher delta. Let's double check that. What do you mean by that? And so this is kind of an epiphany moment. Everyone, put your sunglasses on so you can actually see the sun here. Okay, the light is going to come right. It's coming. Now, what I'm going to do is let me add this. What do we mean by that? Well, if you did a classic vertical, okay, your delta might be, let's say, 10-ish or so. But if you did a caller like the way we discussed, the delta is probably going to be 2 to 3 times the delta of a vertical because you really own the underlying shares. All right. Now, what about that trade? Now, by the way, let's speak to this for just a sec. So Skylo, I love where you're going. So let me ask you, how do you manage that position at the bottom? I don't want you to think about it like super complicated. Let's just use basic math here, okay? So let me pick a different color. We want to see, is there enough money to say, hey, we're gonna get out of this trade. All right. So by the way, if you have a little sheet of paper, bring it out. We bought 100 shares at 150.60. And we just want to know, where's the upside potential? The upside potential, the 155 call. Can everyone tell me what's the maximum gain there? That's about $4.40. And the downside was the 145 put. There it is. All right. Now, what we want to find out is, did we get a call? Did we get a credit or a debit? Well, you collected 6 and you paid $5.10. So the credit there was 90 cents pre-commission. So it's like you can make up to 155, add 90 cents because you got a credit. All right, now, question we want to ask. So how much could we make? I mean, isn't that always the question? How much could we make? Well, if we look at the basic math, you can make from there to there. That's $4.40 plus the 90 cents. So what's the maximum gain we can make on this position? Answer, $530. Now, how much of that do we have now? Well, we have $214 of the $530. Now, it's not perfect, but we're probably about 45% of the way to maximum gain. What is the paid money account going to do? We're going to close the oven and let the cookies bake further. Now, what would actually make us to start to get a higher and higher percent of the maximum gain? Stock goes up even farther. Okay? Now, so let me ask you this. So how much could you lose? A basic math question. Let me take it to the red color now. Well, if we bought the stock at 150.60 and the stock could go down to 145, who asked me that question, Michelle, how much is that? Answer, $5.60. From 150.60 down to 145. However, you also got the what? Credit. And if you look at that and say, okay, so what's the max loss? Answer, $4.50 or $450. So we were trying to make $530 to the upside, and the downside has a potential risk of $450. It's defined risk. So this one still has a little bit to go. Now, is it a bad week? Absolutely not. 45% a week. Some people might say, I'll take it all day long. I'm not saying anything. I'm just saying that's what they would say. Okay. So we're going to kind of let that continue to cook. It's a positive delta, so you want that stock to go to the upside. So trade number 1 here is really adding to that position in the margin account. When we go to the IRA account here, we're going to right click on that 150. And then what we're going to do is go to vertical. We're going to go to that position. We're going to take that, the 150, 160 strike, and there's the debit there. Okay. We talked about this before. I'm just doing it now in the IRA account. Now, what I'm going to do is going to go confirm and send the order. There it is. Now, let's kind of go to a different one for just a sec. Now, some of the stocks that were kind of interesting in this last week, go to a stock example given like Berkshire Hathaway. Can you believe this thing? Stock completely fell down, and the stock ricocheted right back like the drop never happened. Guys and gals, that happens, okay? Sometimes people get stopped out or emotionally sell when they can't take it anymore, or they don't want to take it anymore. And then some people say, I will take those shares, the investor says this, I will take those shares off your hands so that way you don't have to feel as emotional. Now, a week later, you kind of, some investors maybe should feel bad for those people, but they sold them down here and they just said, hey, I'll take them off your hands. They just went right back up. Anyway, does it always do that? Absolutely not. But so far, one party coming out perhaps a little bit better so far. Now, I want to go back to just real quick, couple stocks that we're going to keep our eyes on, okay? So number 1, when we take a look at, let's say, a stock like Costco, okay? Now, if you look at a stock like Costco, it's dropped down, right? It's gone up to an area of resistance, kind of holding so far. Now, let's say we're going to go back to the IRA account. Why? It's a little bit bigger account that might be able to handle a bigger dollar trade. Now, so far on that, we do have a position on that, but I want to try to overlay another position on top. Now, this might surprise you, okay? We're going to go out to the Junes as well, and what we're going to do in this case, now, I'm doing this on purpose. This might kind of surprise some of you that you say, wow, these are $4,000 premiums. You got to remember, you're collecting one, paying the other one. Now, what I'm going to do is I'm going to try to be a little bit conservative where we pick the strikes, okay? Now, if you look at Walmart, if you look at Costco, they've kind of showed some signs of potential healing, where if you take example given something like a Target, they have not really shown any signs of rebounding yet. Now, if you take a look at this, if we did, let's say the 945, 935, okay? This is what we call a probability-based trade. If someone sells the 945, this is for the Junes here, thinking the price should stay above the 945. The delta is telling us statistically the odds of the stock to close below that strike by a penny right now. The delta 35 is also stating, okay, it's if the stock goes up $1, the option prices might move approximately, given the model, 35 cents, okay? So think of it as the change in the option price over the change in the stock price. Think of it as a ratio. Now, what we're going to do in trade number 2 is we're going to sell, okay? Now notice this. As someone who trades options, the investor has a defined risk built in. If someone is a stock investor, they don't have a defined risk outside the stock going to zero. This is why it can be a little different for some investors. Maximum gain given the vertical, maximum loss, and then notice the commission there, okay? Now what we're going to do is going to put that in the IRA account, and we're going to send it, okay? Now just kind of give us some quick reminders, right? When we talk about like what would be a really good gain if it were to occur, anything above 80% with 20 or so days left to expiration would be phenomenal. 65% with more than 20 days remaining. And if the paid money account got 50% in the first 10 trading days, that's a solid gain for some investors, okay? Now, I want to kind of just show some other stocks that kind of actually had a pretty good rebound, okay? RTX is one that's had a pretty good rebound. Last week it was at 112. It's at 129, okay? And it's almost filled the hole. What I want you to be doing is kind of watch for stocks that have filled these gap downs. If they have filled in the gap downs, these could be the ones that could try to make the higher lows and reverse back up, okay? If you were a bear, that's not a great sign that we actually started to fill the gaps. Now, the other one that we actually saw some pretty good strength on, which we're going to practice this trade, is GD, okay? GD is a stock, if you take a look at this, most of the touches are right around 270. A second area of the touches is right around 277. Now, the nice thing is about with earnings upcoming next, it's the 23rd, whenever that is, I believe it's next Thursday, we take a look at that, we're kind of touching these highs again and again. Now, option number 1, I'm going to wait, and the investor might say, to what happens with earnings. If this stock went down in this magnitude, let me zoom in, goes all the way down, okay, runs all the way back up like the whole drop never happened, okay, and what you're going to notice is it's filled in the hole. Now, do we know the reaction it's going to have over earnings? Absolutely not, okay, don't have a clue. Nobody does, okay, might have some ideas, but we don't know the reaction from investors. What is it going to be? Now, what we're going to choose in this case is we're going to come to this. Let's go back to the paid money account. Let's go back. Let's try to see if we can't work some of that capital in the margin account. And what I'm going to do there is I'm going to go look and just double check, is it possible to maybe do an option trade on this? It's about 60 cents wide. Now, it might be that wide because of the upcoming earnings. We could also just double check, well, what's the, bring the basic price and quote back up, open interest. So if we kind of said, where do we see a little bit tighter bid-ask spread? It's on the 260s, okay? And that's where we're getting most of the open interest. If I go look at the Mays and said tight bid-ask spread, 40 cents on the 250s, 30 cents there. So Mays are possible, but you're probably thinking, hey, I probably want in this case maybe something where I try to get the mid price the investor is probably thinking with that comment. Now, let's go ahead and do this as an example. Let's say the investor says, James, I want to take a trade where I think it could stay up above a current price level. Now, notice this right here. You got 32 for the Mays, and you got 29 for the Junes. So if someone's selling something, they might try to target Mays on purpose, okay? Now, what we're going to show is you got the 35 delta, then you got the 23 delta, and then you got the 15. If we said, for example, we're going to sell the 270 put and then buy the 260, well, could we do that in the margin account? Well, I'm going to have to double check. Sell vertical. And what we're going to do, if I did that, you got a $2.50 credit, but the max loss is going to be $7.50. So on this one example, I'm going to have to, well, don't have to. It's up to you what the percentage you want to take as far as loss. If we said in this account it's about $30,000 and this max loss is $750, it's 2% of the portfolio. Now, some people take that, okay? But for how we started this portfolio, it would be too much. We're going to have to move it to the IRA, where if we lose, let's say, $750 of that account size for the IRA, it could handle it per the criteria that we talked about. It would be at the upper threshold of what it can handle. Now, I'm going to go ahead and note the commission, send the order. So the biggest takeaway I want you to be watching for here today and over the next couple of days, be watching for some stocks that are filling in the gaps. Significance. Well, if you're a bear, okay, and you're seeing some stocks that should have stayed below these large red candles, but they didn't, okay? And all of a sudden you're seeing when it gets above, long tails. Someone is actually covering short potentially and or just going long. Now, other stocks, as we close here, AIG, for example, has gotten a pretty good bounce back. AT&T has gotten almost a crossover there. We also see, for example, Netflix kind of at a diagonal line of resistance, upcoming earnings. Keep an eye on that. And when you also take a look at, let's say, a stock like CrowdStrike, that's also one that, for example, is maybe on the verge of trying to get a little breakout itself. So some better signs of what we're seeing from last week till now. Could that continue? Now, I'm out of my time here today. When we take a look at where the market is finishing, or at least at the end of this class, it's up about 30 points or so on the S&P 500. Cameron May will be coming up next. Make sure that you have subscribed to the Trader Talks channel if you have not done so already. We'll continue to monitor these portfolios and manage these positions throughout the week. But we did 2 to 3 brand new trades as well. They were bullish, but we wanted to kind of put those on at the start of the week. Now, remember with what we said, it was done for example, illustrative purposes only. Thank you, Connie, for answering those questions in chat, and thanks to all of you as well for your comments and questions. This has been the class on trading with technical indicators. Stay tuned for Cameron May coming up next. Thanks so much. Take care. Bye-bye.